I wanted to take a moment to talk about our sponsor, Alt21, the foreign exchange and hedging platform that reduces the risk and cost of cross-border transactions. As a board member, there are few better feelings than making a suggestion which adds quick material value to your organisation. I remember when one of our board members saved us $50,000 with a quick introduction to a group discount scheme for one of our key suppliers. I continue to feel grateful to this day. Alt21 can offer exactly this kind of quick win for board members. By using their foreign exchange and hedging services, you could reduce your company's costs by 90%. For a company that has just 10 million foreign exchange exposure through its revenues or cost base, that could be over $300,000 back into the business. All21 are so confident that they offer the best value in the market, they show you how much they make from fees in real time before and after any transaction. If you want to save your organisation money on its foreign exchange and hedging, head to alt21.com. That's alt21.com to find out more. Hello and welcome to Enter the Boardroom with Newroll, the podcast exploring what makes great boards and board members. I'm your host, Oliver Cummings, CEO of Newroll, the board search specialist and market leader bringing science to the art of board hiring. Today's guest, Mark Winlow, is currently chair of several financial services companies, including Aon in the UK and Redwood Bank, a profitable UK challenger bank focused on SME lending. He was a partner at KPMG, AT Kearney and EY. He also co-founded and chaired the audit committee of Starling Bank, helping set up and shape one of the UK's most successful digital banking platforms. Over the past decade, Mark has transitioned into non-executive leadership, serving on 18 boards and chairing 11 of them, across both regulated and high-growth sectors, including chair roles at Novia Financial plc, Liberty Specialty Markets, McTavish, Wellesley Group Investors, Aegeus, Personal Group Holdings plc, Aon UK, and Ned roles at Onmo, Tesco Underwriting, and AIG Life Limited, and others. You've had extensive experience on the board of insurance organisations, which I'd love to do a deep dive into now. And can we perhaps start by exploring 3 boardroom moments in your work with insurance companies where you feel the board has changed the trajectory of the business for better or worse, and maybe one where the board stopped a bad decision, one where you pushed them for more risk, and one where you unlocked an opportunity or had to change yourselves?
Yeah, I guess the ones where we've stopped stuff is probably easier for people to, we stopped them doing that, we said no. I think that the saying no is a question of things like expansion into different markets or into different aspects of insurance in place. And certainly overseas expansion from the UK is what an ambitious CEO might want to do and might want to take a business abroad. But I think one of the bits of advice that the boards I tend to get on is, well, let's do step by step. Let's dominate the UK market, which will allow us to expand into others. Others will have a view that you could shoot off and have lots of flags around the world. But I think that's the sort of advice that has steered some of the organisations into not stick to the knitting, but more around, what is the core of what we do? And therefore our strategy is about that purpose, delivering that to success. And the other things, let's recognise either they're going to add value or they're going to protect the value we've got. But actually some of them are a bit of a stretch. Why would you want to open up in Germany? What, because you speak German? Well, that's a good reason. Yeah, the board should do that. So I think that's some of the things where we've stopped things. The third one about checking more risk. Again, one of the insurance companies I was at had grown over a couple of decades really into quite a substantial business in the UK. And as a result, we were taking ourselves probably, and we were a significant part of a group, probably too seriously in terms of we can't make a mistake because it's going to be a big mistake because we're big. And so part of it was the non-execs pushed the executives to try some stuff. And in particular, using new technology, using different segments of the market. And they tried that, which was great. It didn't quite work, but it did mean that we had pushed the boundaries and got them used to operating a different way. So I think that was quite useful. And it was a useful step, and the company was Aegeus, is a useful step ahead of the strategy that I was involved in helping Ant Middle, the CEO, do, which was, let's not do everything. Let's do some things really well, and in particular, personal lines through brokers. And that's been a real success for them.
You talked about your experience at Personal Group, which is an interesting one there, because you, during a CEO, were there during a CEO transition, and I think you originally brought in Deborah Frost onto the board as a first-time non-executive, and she went on to become a CEO, which is a trend I'm seeing, I think, happening more and more. Really interested to hear your insight on that process and what you learned from it, that a board member listening who might be considering doing the same, putting one of their board members into an executive, if not the CEO role, can learn from.
Well, I think there's a danger in doing it for the individual, because I think it's quite hard to start a non-exec career and then stop it and then come back and tell me, yeah, I want to be a non-exec again. And I'll just think you're going to go off and get another exec role. And nobody wants to be the sort of in-between partner just while you find a better one. So I think that's a danger for the individual and how that person thinks of it. So you've got to help them with that. But I think it's all about what are the right skills for the business. And if we've got them in the non-exec, then why shouldn't we look at that person as a candidate? And Deborah had a tremendous set of skills that suited Personal Group and was therefore ideal as the choice of a CEO. And it's the same way as Amanda Blanc and I used to work together at EY. And Amanda, when she left, she left Zurich, she went into non-exec roles. I probably suggested she went into too many at once, but she was obviously going to be popular. And she's been the right choice of Aviva to take her from being a non-exec to being the chief exec. So she's probably the highest profile example of how it's worked successfully. Deborah's another great example of how it's worked successfully for that business. So I think it's partly about the motivations. I don't think either of them, knowing both, but particularly Deborah, intended to join the board so they could become the chief exec. And I think that's quite a dangerous course, because you end up not being respectful of each other. The politics start to take over. So it is about, let's make sure we ask the right questions and find the right person. And if that person's on the board already, that's even better because they understand the business.
Now, what's striking to me about those three formative experiences that you've talked about in insurance companies is they have very little to do with insurance per se. What are the heuristics and key levers that you're focused on as a board member coming into an insurance business?
One of the filters I use is, do I understand the engine of the business? So what's its purpose? What is it trying to do? What's the engine? So if you look at Starling Bank, Anne was talking about an engine that hadn't been built. If you look at Redwood Bank, it had an engine and it needed to be sort of refined, but I could understand both. And I've never been a mortgage lender before, but I understood about sort of getting deposits. We've got some money to lend, and we lend out as mortgages. I understand mortgages because I've got one. So that's, if you don't understand the engine and it's too complex for you to understand, then you're going to be danger to yourself and danger to the business. So I think even if it's at a high level, understanding who the clients are, where the money comes from, what they're buying, why they're buying it, and how do you deliver it, those are all good questions to understand an engine. Because if you understand the engine, so I've been involved in electric motorbike taxis in Thailand. I understood what the engine of the business was, and I've been involved in reinsurance, life insurance, motor insurance, specialty insurance. All of them are different, but if you've got a frame of reference to hang it on, then I think you've got a good chance of understanding a bank, an insurance company. The layer that is complex is that it's probably the difference between sort of insurers and banks against other financial institutions is a capital question, because you've got to have the capital in place if things go wrong. And so there's some complex and quite onerous ways of demonstrating you've got the capital, one, to do the business you're doing now, and two, to continue doing it if things go right. Because I've been in financial services 40 odd years, and I remember I ended up designing a trade credit insurance scheme for the Labour government under Gordon Brown after 2008. If you'd asked me a year before, I wouldn't have been able to talk about trade credit insurance because it runs it in a different way. And so I've helped people go into the warranty business, to go into general insurance, more easily understood car insurance, house insurance, because we tend to have them. So it is partly about the insurance and what the proposition is. But the key thing is, you've got to have it, you take some risk on, and somebody gives you some money for you to take that risk, and you've got to have the capital if they make a claim. And it's a different way of financial services. You get the money up front, and then you pay it out. If you look at banking loans, you lend the money out, and then you get the money back. And so those are quite different sort of models, and therefore you've got to understand you've got to have enough money as an insurer to pay it out should you need to pay that. And that was an interesting challenge with the Treasury, because they said they were willing to risk 40 billion on this trade credit insurance scheme, and they said, well, when might we need it, over how long a period? And the answer was, well, you might need it on day one, because if everybody claims on day one, you've got to pay it out on day one. So I think there's some simple dynamics like that, which is understanding it. I think if you've not been in financial services, the regulatory situation and approach is quite important, because in some ways I think financial services held to a higher bar than lots of other companies and lots of other industries. And I'll avoid being political about the approval of financial institution board directors and the appointment of treasury ministers. One has to spend quite a lot of time proving that you're capable of doing it, and it's probably a minuscule amount of the overall economic, financial aspects of the country. So we have some quite onerous regulations and expectations on us as financial services directors.
So you've talked there about the importance of getting your head around the capital base and situation, the importance of getting yourself around the regulatory levers, the engine of the business, which I guess comprises both the underwriting side of it and ability to understand risk, as well as the investment side of it and the ability to understand how they're generating returns. If you've got your head around those four things, is that the sort of the distillation, the essence of where you, in your experience with insurance boards, have been able to most affect change, or is there anything else missing from that list?
Again, I guess my discussion I had, because I took lots of advice before becoming a non-exec, and one of the discussions was around what do we as non-execs do, and what does a board do? And the distillation, and with Bischoff, who's sadly not with us anymore, so the discussion I had with him, he said, well, we do three things. Blocking and tackling is, I don't think that's the Dutch word, but it's my word for saying, well, you have to do the governance, the regulatory stuff, be legal, and do the right thing. That's an important aspect, because if the business is not directed properly by the board to do those things, then we'll be tied as a business and as directors. So you've got to do the blocking and tackling, but then you've also got to do the strategy, which is, if you understand the engine, then you understand where the business could go, what it could do, what it might not do. And then the third one is the people, and the people who can then deliver the strategy and make it work. And I think as a board, we look at all of those things. We might only look so far down in terms of individuals, but we do have to look at the culture and the nature of the business, how it operates, and how the leaders are influencing the rest of the organisation. So I think those are the three bits. Then there's the bits of putting people together as teams, succession, and we talked about CEO succession. My wife, after 2 years as a non-exec, she said, you said you're going to do three things. You've talked about the people stuff. When are you going to do the strategy and the blocking and tackling? Because there's a lot of people stuff in being a non-exec.
You talked about you only go so far down. I'm reminded of that Pareto's law principle of 20% of the people typically are doing 80% of the work, and it's not always distributed in the way that you would expect it to be. Often it'll be someone right at the bottom of the organisation or towards the bottom of the organisation, in the organisation chart at least, who is contributing significant value. How far down do you go, and how do you determine how to do that as a non-exec?
I think you can't be a non-exec just by attending board meetings and committee meetings. And you have to have some data points, I think, in the organisation. So you've got to get into the organisation and talk to people and see, I guess, that everybody involved in the organisation at some level, so you understand how it works and how people work. Yeah, so if you look at a Remco, so I chaired a few Remcos, is we look at the executives, the EDs, we'll then look at the ones who are the big risk takers or have got approvals from the regulator. We'll possibly talk about some of the people in the next layer down, but we won't necessarily talk about all of them, and because they're not necessarily going to be the successor directly, or it might be 5 years out, and there might be several of them. So that's how we go down the pyramid of people. So we won't necessarily understand what all the security guards are, or who they do, where they report. But there's no harm in talking to the security guards as you go in and out to get a perspective from 1, 2, or 3 of them in terms of how things are working and what they're saying, that sort of thing. So I think the investment in understanding and talking to individuals, because you never know everything, especially as a chief exec, that size business, it's going to be difficult to know everybody. And I think that's again, historically, I'm probably not as well bred as you, but I think about the Roman centurions. There was a reason why they had 100. In fact, they had about 80, which is what I had in my squadron, because one person can only really know 100, maybe 150 people really well, and that's why I think some of the challenges for startups is when you start getting over that 100 mark. How does the founder then allow the business to grow? Because they will no longer be as close to the 300 people as they were for the 100 people. So I think it's again, if you understand how that cascades, then you talk to your centurions and you're effectively understanding what 300 people are doing.
Certainly top of mind for me as New Role approaches 100 people. And we had a wonderful discussion in episode 120 with Tim Jackson on that. How do you create that cascading? But I'd like to talk to you more about regulation, because you've touched on that a couple of times now, and you have chaired and been on the boards of organisations who've been regulated by both the FCA and the PRA. For those not familiar with the differences between conduct risk versus prudential risk, can you explain what those regulators do and how you interact with them as a chair and board member?
There's actually more regulators than you realise, and so. But if you look at those two key ones, the PRA, which is part of the Bank of England, is essentially making sure that the financial institutions in this country have enough capital to survive and to not be a risk to themselves and to their customers and to the economy. So that they're very much around, are you strong enough? And the conduct, the FCA essentially does more of the, are you doing the right things by your consumers, your customers, and what have you. And I think that we used to have the FSA. In fact, we used to have lots of different regulators who came together as the FSA. And I think one of the criticisms I had about the regulators was by segregating those two duties, we also lost the responsibility for making sure we look out for the UK financial services industry. That's been added to the FCA more recently, and we've seen some of the changes in the regulatory stance as a result. I think it would have been better if we had that in all along, and some of the more complicated things might not have been foisted upon us. So I think in terms of the relationship with them, you have to have a relationship with them if you're a chair. And I think the key thing for me is they're trying to do a job that's important, which is to stop the wrong things happening in financial services and the wrong things happening to customers. So I have a lot of time and I have a lot of sort of, I guess, resonance with treating customers fairly. Why wouldn't I treat customers fairly? I feel as though I've got a duty to consumers, so why not consumer duty? So there's a bunch of things that the regulator's trying to do that I totally agree with. I think that the challenge is always when, and you probably gather, I don't use complicated analogies, but it's like, are you putting something in place to stop the bad guys? And if it is, will it stop the bad guys? Or will it just make the good guys less effective? Because the bad guys will do it anyway. So I think there's a challenge about some of the regulation. Is it overburdening the people who are doing the right things? And I think the FCA, for instance, are changing some of their tack in the last 6-9 months to recognise that. So I think the best advice I have is, they expect you to be open and honest, and that I think you should be that, and I think you should have you should trust them to understand the business as your perspective presents it. And as a result, if you're, it's not a game, it's not a competition. They're actually like a coach trying to help you be a better hurdler. They're going to say, well, I don't think you should do that. I think you should do some training on this, or you should do this before you start. You should look beyond this hurdle, or whatever it is. They're almost a coach in that sense, because they know what the rules are. Just like having an ex-referee coach the England scrum about, well, this is what we're looking at nowadays in terms of cheating and how we expect you to operate as a prop forward. And so I think if you respect them for that, you can criticise some of the things they've done, but you need to respect them, and I think I suppose that better asking the regulator, but they seem to respond to that. And I've been involved in a couple of areas where the companies I've been involved with have been on the naughty step, for want of a better phrase, and I've helped remove some of that tension.
Positioning yourself for your next board role is different from landing your first. New Role Plus gives you personal expert support to refine how you present your board value, strengthen your expertise on fast-moving topics, and unlock more prestigious opportunities. Head to plus.newrole.com to find out more. You joined Anne Bowden at Starling and were there when Tom Blomfield joined, and also when he and others left and went on to found Monzo. There must have been a degree of anxiety across the organisation at that moment. Can you talk us through the situation and the journey you subsequently went on as a board?
Yeah, so I suppose if you just come back, so in 2014, Anne and I have been contemporaries in Pricewaterhouse, so we knew each other from the 1980s. In 2014, I'd worked with her as a consultant in a couple of guises, and she said, I'm going to start a bank. I said, oh, that's good. You'll need a non-exec then. And so then there were two of us, and so I claimed to have doubled the size of Starling in one day because there were two of us. And so the early days was sort of like trying to bring people on, and again, recognizing my strengths. At that point, I don't think I was credible as a bank chair. I was credible as a chair of a board, but not as a banking chair. And so I was never going to be able to take on the chair role, so we needed to find a chair. We got one non-exec, and we got a couple of really able people, including Tom and others. And the mission and the purpose was to build the best current account in the world, as I would describe it, as defined by our customers. And that was the ambition. I think the challenge we had was, I could be very careful how I describe it, but it wasn't just a dispute. It was a difference between building a tech fin and a fintech. And Anne was building a bank that was going to exploit technology. And Tom wanted to build a technology company that could, probably not the right word, but exploit banking. And there was a reward challenge in there as well. And there was, if you're getting in my way, we're gonna make you go into administration. We're all going to resign, and that's what they did. But with Anne, she's a forceful character, and really my advice was, lock the doors, change the passwords, go away for the weekend, and we'll start again on Monday. And that did. So Anne's got to her credit. She's the formation of two of the major sort of new banks in the UK. Monzo, which was better at marketing than we were and got a lot more customers, and Starling, which has been profitable for 5 years. And so you've got some quite differences in there. But it was a rough time.
What do you think they got right on marketing that you would do differently a second time round?
Well, they grabbed market share using a prepaid card, really. And so we were keen to not get into the prepaid card. We wanted to have a proper debit card and get a license as a bank. So that allowed them to then advertise and market their product more eagerly and to more people than we could. And I think certainly the rule of thumb I took away from those days was to get the first 100,000 customers. It was really hard, and we had to almost win every single individual customer. Once we got past 100,000, actually you got into a virtuous circle. And so I tell stories about, like, my youngest daughter at the time was out with some of her friends, and they said, "Oh, you should use this Starling card." And she went, "Yeah, I know, my dad helped start it." And he went, "No, he didn't." And because they knew me, they didn't believe I could. I think that was great, because then you start seeing that, and people still do that today, which is it's great. I recommend other people to use it. So Monzo got into that space quicker than we did.
So I'm fascinated, though, to really understand, why did you think that was a mistake to take that prepaid card route? What did you get wrong in that assumption with hindsight?
I think at the time, what I felt, and I think we felt, was we were behind the curve, and the valuation of Monzo was significantly higher than the valuation of Starling Bank, even though we were providing a better service than they were and a better current account than they were. But because they had more customers, the valuation of them was higher than us. We were both sort of spending money. We weren't profitable at that point. So I think at the time it seemed disappointing that we weren't seen in the same light. And I think with hindsight, it's like, I think Starling has done a much better job at building a bank that's profitable, that's in SMEs, and is now, because you start off with, we're trying to build the best current account in the world. To do that, we've got to get rid of some of the old systems and the old models of systems. So we've got to build our own systems. If you build our own systems, we've got some pipes we can rent out. And so DWP and others started using our pipe work for payments. And then you go, oh, actually we do it for some retail customers. We could do it for SMEs, because a sole trader is not much different from Mark Winlow going down the shops or whatever. So that's we got into SMEs. We're then able to take advantage of two big changes in that space, which was RBS having to put money into its competitors and COVID loans coming out as well, which give us some guarantees around what we lend. But then you've got an engine, and strangely they called it the engine, which now you can sell the bank in a box, and Starling have been able to do that. So that was always a view that at some point you might change the structure, and being its engine, the first customer, which was Starling Bank in the UK. It's a bit like the American Airlines and the Sabre ticketing system. It got bigger than American Airlines. And so American Airlines ended up being one of the customers of the Sabre ticketing system. I think Starling is one of the customers of Engine, although it's all part of the same group. So I think it's developed much more healthily, and has got a much broader footprint, because on credit to Anne was determined to build a proper bank that exploited current technology.
So that sounds like you don't actually think you got the decision wrong, but it was the way the market valued what you were building meant that they were able to go faster, at least on the outside. But it sounds like what you're saying is you think over the longer term, your greater understanding of that market will enable you to grow a more enduring and valuable business.
Yes, but I would say that, wouldn't I? Because I was on one side rather than the other. But yeah, I think that's true. I think it's I played a bit of sport when I was younger, and usually sport finishes at the final whistle, but business doesn't, and it just rolls on. It never ends. And so, if you take a slice now, you can say these are the most successful companies in the world, or this is the best bank in the world based on either market cap or customer service. But if you roll forward 3 months, 2 years, then it'll be a different combination. So you've got to continually play to win, even though there isn't a final whistle.
It feels like a tortoise and a hare parable. I guess the question is, if a board member listening to this finds themselves in that situation again that you found yourself in, would you counsel them to do exactly as you did and build the fundamental business? Or is there some merit, if you can spot that investors are going to value the hare approach, to actually compromise a little bit on the fundamental business to get the funding and get yourself in a situation where you can get there faster?
Yeah, and I think I think what would be good is if, and again, Starling was fortunate to have a backer who was going to invest from getting us to authorization with restrictions, getting us through to full authorization, and getting us to an operating bank within a year after that. So we didn't have to worry about the capital, and we had a plan to follow. I think it's difficult, and lots of chief execs especially founder chief execs, are spending most of the week persuading people to give them money so they can survive the following week. And so getting product out to customers is sometimes the quite right answer. It might not be the final product. So I'm working with another company, Onmo, and they're continually improving their product. But again, it's a bit like lots of theories around, well, let's get a market viable product out, see what people think of it, and then shape it after that. So I think that's a proper way of doing things as well. But I think the principles which Anne and the Starling board were ascribed to was, we want to do it properly. You can't really do a half-cooked banking system, credit card, current account. You have to do all of the things properly so that you can't get defrauded, people can get paid, all of those aspects, you've got to do them properly. And I think the difference was that Monzo took that viable product as a payment card and pushed that then out first. We continue to take the main route and probably had a better banking system than they did by the time we went live. Because we both got approved at the same time.
Mark, time has flown, which means it's time for the lightning round, where I'm going to ask you a question and ask you for a quick response if you're ready.
Yes, that was my quick response.
Best book every board member should read, and why?
Rebel Ideas by Matthew Syed. He brings sort of interesting perspectives and stuff, and in that it's made me think about, and there's a couple of aspects of it which are really relevant to the board, and in terms of whether it's inclusivity, whether it's about asking the right questions in hierarchies.
Boardroom behaviour that irritates you most?
It's the side chats, like, I didn't believe that either, sort of thing, because it just creates a cacophony of noise and distracts people.
One board ritual you'd keep and one you'd scrap?
I suppose the one I would keep is, and so I like to remind people, the purpose of this meeting is to look out for the interests of this company, wherever the company is. What would I get rid of? It's probably one about food. We seem to spend a lot of time in board meetings eating food, getting food coming in, leaving lots of food.
What's the most sleepless night you've ever had as a board member?
I've got two talents, one of which is I can sleep almost anywhere. And I don't know what the other one is, but I must have a second talent. But it means I don't have lots of sleepless nights. I think I've had lots of worrying times, and particularly if you're involved in startups, then you've got to be recognizing that things might go wrong. And the number of board meetings I've been involved in where the first question is, do we have enough money to pay the staff at the end of the month?
Most significant professional insight?
I guess one of the things that I think is quite useful the phrase that nobody is nobody. How you treat people with respect, irrespective of their rank. I think that served me well in being able to deal with lots of people, really. And I think it's probably a good insight somebody gave me a long time ago.
A boardroom myth that needs busting.
You don't have to be a finance person to chair an audit committee.
What have you changed your mind on about boards over time?
The dynamics of a board and where it fits into the organisation, and shifting boards from being a reporting board to being an active board that supports the business. That's certainly one of the things that I've seen change as I've got older and more experience.
When was the last time you got a significant judgment call wrong in the boardroom, and what did you learn?
I think the aspect I find I've made more mistakes on is about stakeholders, and making assumptions about stakeholders, or making assumptions about how the stakeholders are being managed. And that was a case where I thought a member of the board who had known a major stakeholder for 50 years was keeping that person informed, and they had a major amount of shares of the business, and was presenting what the board was talking about in the way the board talked about it. But that wasn't the case, and that meant we had quite a bit of disruption from the shareholder because of the misinformation or my absence of management of that stakeholder. So I'm still learning, and I guess in terms of the stakeholder management, I don't think I'll ever get it finally right.
How are you investing in your development as a board member?
So if you look at the companies I've joined, and Redwood Bank's a good example, where it had stakeholders who were quite different, a rich family office and Warrington Council. I joined another board because the founder and chief executive is Israeli, and this funding is coming from two Saudi families. So they're on the board and I'm on the board. So I'm learning about different stakeholders, and I think that's a key bit for me, is to because one of my responsibilities is to look out for the interests of the stakeholders, as well as to look out for all the other stakeholders as well.
And one of the things that really impressed me when I met you was you participated in our chair masterminds, and you get some chairs who've got the experience you've got who say, why would I ever want to come along to a mastermind? I'm here to educate other people. But from what I've seen in those sort of personal interactions, you've got a wonderful growth mindset that you're constantly sort of open-minded and looking to learn from others.
I hope so too, yeah.
Finally, 3 things our listeners should take away from this podcast if they take nothing else.
So one of the things is, I think my nobody is nobody is a good one. So I would talk to everybody in the organisation you're involved with, just pass the day with them and find out what, because you'll find out stuff and see how people perceive things. I think that's a good one. I think another one is about, I think you need to want to succeed as a non-exec, as opposed to not want to fail. And I think that's quite a distinct difference, because there's a number of non-execs I've seen who don't want to fail, and therefore, when I played rugby, the only time I got injured is when I was hesitant in the tackle. And it's the same thing with being a non-exec. I think if you want to succeed, look to the way they're succeeding. Obviously minimise the risk of failure, but don't emphasise on not failing. And I think the other one is, think of the engine of the business you're going to join. If you understand it, then you can probably be a non-exec on it. Mark,
thank you so much for taking the time to share your wisdom and experience.
Well, thank you. I appreciate it. I'm not sure about my wisdom, but certainly I've given you some of my time.
If you're ready to position yourself for the next stage of your board career, with expert advice behind you, New Role Plus can help. As a listener, you get 10% off. Head to plus.newrole.com and use code ENTER at checkout.